Hi, I'm Robert from Mr. Insurance, and welcome back to our life insurance series. Episode number 2 on the 5 things you need to know about buying life insurance is the types of insurance. We have insurance on humans and we have insurance on everything else. Insurance on your phone, insurance on your car, insurance on the building. But insurance on humans, we have 2 main components. That is life insurance and accident and sickness insurance. We're going to talk about those 2 today. Let's get ready and dive in. I'm Robert from Mr. Insurance, and I have the privilege of being joined here today by Joyce Latek from Canada Life.
Hi, Rob. Hi, guys. My name is Joyce Latek. I'm the Regional Sales Manager in BC, and I deal with both living benefits as well as life. So I'm basically the point of contact for many advisors like Robert himself. And I'm just going to touch on different types of insurance when it comes to life insurance. If you have, say, a specific temporary need, term insurance would be a really great fit. And what's nice about the Canada Life term insurance is that you can pick any length between 5 to 50. So, for example, if your mortgage amortization schedule is 25 years, that's where term insurance will be a really great fit.
Now, talking about term insurance, Joyce, there's creditor insurance out there, and a lot of the mortgage brokers push the creditor insurance because there's no application process, really. What is the difference between creditor insurance and term insurance?
The best way to answer that is term insurance will give you the flexibility. So it does not dictate how you can spend the death benefit that gets paid out to your loved ones, right? Creditor insurance, once you pass away, you won't even see a dollar of that amount because it gets paid directly to the creditors. The last thing that you want to do when your loved one passes away is to pay off your house, right? You might have different needs. You might have to, replace this person's income. So in that sense, term insurance is definitely the way to go.
And term insurance is a great way to get into life insurance because the cost is a lot lower. It is for a specific period of time.
Also got to think about when you're talking about term insurance, what happens after the term is over. So if you purchase term 20, there's a great chance that you're going to outlive those 20 years, right? So, you would need life insurance after the fact. After those 20-year term is over, then you have the ability to convert that term insurance to permanent products. So we're going to touch on UL and PAR. These are permanent insurance that can basically take care of you until you pass away.
So if you do want to start off with a permanent policy, what are the 2 main types of permanent insurance?
Universal life, the best way to kind of describe it is with UL, you have control over the entire portfolio. So you get to dictate how you're going to invest that particular amount into, say, fixed portfolio, balanced portfolio, whatever the case might be. Versus PAR, we manage the assets for you. All the dividends that we pay out to our policyholders are vested, so it is a guaranteed growth. It is more suitable for people who are maybe not sure about doing their own investments or who might be more conservative and who likes that guarantee.
And I know now you're going to share a little bit about the inside. We're going to get an inside view of the PAR product.
Yeah, for sure. So when we're talking about participating life insurance, and then when me and Rob talk about PAR, PAR, and when you're having this conversation with your own clients, you always gotta ask, okay, why do you need life insurance? When do you need it? And what are you going to use it for? And when it comes to PAR, there's obviously many needs, but PAR addresses your permanent needs. So we're talking about estate planning, your succession planning, and especially if you're a business owner. You pretty much worked your entire life to build up your wealth. And the last thing that you want to do is broaden your wealth, especially, if you were to pass away, CRA getting a big chunk out of your business just because of the tax issues associated with, you passing away. So PAR insurance can address all of those in the most cost-effective way possible. And this is something that you should definitely have a discussion with, especially with your business clients who is doing a estate planning, who's doing a succession planning, because most of them, when you're discussing life insurance, they would just probably think about, okay, yeah, like I die, and the death benefit goes to my beneficiary. And they just do not know the intricate part of what PAR insurance can do for their business. There are many benefits to structuring a life insurance policy, particularly PAR insurance owned by the corporation. Because if you, as a business owner, were to pass away, the death benefit flows through your corporation, and it creates what it called a CDA credit. So that's the capital dividend account credit, which will be flown out to the shareholders tax-free basis. So this is the number one reason why we should always discuss when we're doing an estate planning or succession planning to the next generation. Because if you are, I'm just going to throw this out there, if you're doing any sort of estate planning or succession planning with your own clients, Canada Life has a tool where it generates, okay, I have, let's say my business is valued at $1.2 million. Let's just say that. If you were to have that and owned by the life insurance and structuring a life insurance to protect that estate, which will flow through the corporation if you were to pass away, what's the benefit of how much tax will I be saving if I were to do it versus if you don't have any insurance, what is the amount that CRA is going to take away? It is a really eye-opening experience for many of my advisors when they can actually see the numbers and how life insurance can basically save that amount that is pretty much wasted away by the CRA.
Because the insurance, part of the benefit of owning the life insurance with a corporation, we can structure it in certain circumstances to make part of the premium tax deductible. On top of that, those amounts get netted out against the capital dividend account, like you said. The tax on 1.2 million would be almost $350,000. Even if it is a capital gains tax, it's more than 50% of the share value. And most companies that come in to talk to us on the accounting side, they usually have $1 or $100 on their share account. So you're talking, a million, whatever the value of the company is, almost 100% of it is capital gains. But if you can save that 50% of 50% using life insurance, then it's a win-win.
So I'm just going to touch on why Canada Life, because there are, other players in the market, but why us? We have more than 170 years of experience. We went through major financial crisis and we lived through that. And we have not skipped a single year when it comes to paying out dividends. So we survived First World War, Great Depression, 1981 recession. I wasn't even born then, but and financial crisis in 2008. We survived the entirety of these type of financial crisis, and we have never left the par market. When you're investing a huge amount into an insurance policy, you need to be pretty sure of who is controlling your money. And just to kind of compare, in 2020, we gave out $738 million of death claims and $45.2 billion in assets. In year 2020 alone, so this is in only 1 year, we paid out $1.2 billion in participating policy owner dividends. So this kind of goes to show the sheer size of our power account and the trust that our advisors and our clients have in our brand. And with our expertise, our history, Canada Life dominates, in the par market for a reason. It's not because we're big, it's because we're good.
And you're big because you are good. So
exactly.
So I think that pretty much sums it up for whole life versus universal life. Joyce, thanks a million again for coming on.
Thanks, Robert. Appreciate it. Bye, guys.
Hey everybody, thanks for tuning in with Faye Kong from Canada Life, one of the senior representatives at Canada Life. So Faye, before we get into it, maybe just elaborate on your position with Canada Life.
Thank you, Robert, for having me today. The long story short, my background back to university is economics and mathematics. After I graduated in 2012, I just joined. At that time, it was called Freedom 55 Financial, but right now it's a part of Canada Life as well as a financial advisor. So my financial advisor career lasted for a little bit more than 8 years. Then in 2020, I joined Canada Life's wholesale team, particularly in the inside sales team as a regional sales representative for BC for insurance side. And here I am right now.
Excellent. So maybe explain to the listeners the two main types of living benefit insurance, critical illness and disability. What is maybe a small explanation of what each one is and where it can assist a client when they're in need?
That's a great question, Robert. I just use the CI and the DI instead of a critical illness or disability insurance, right? And what's really the difference between critical illness insurance and the disability insurance? Basically, critical illness insurance needs mostly is a short-term needs. For example, if someone is suffering a critical illness, it's a cancer or heart attack or stroke, those are three basic critical illness. So, for example, if these are suffering those critical illness condition, that won't last too long. Usually, we will just think it's probably last 2 to 3 years. That is one reason why when we talk about the critical illness insurance, we always think about a replacement for the client for about the 3 to 4 years annual income, because usually that critical illness lasts that long. But for DI disability insurance, on the other side, it could be short term, could be a long term. Usually we call disability situation less than 90 days is called a short term disability. But if longer than 90 days, we will call this a long term disability. That could last a year. But however, we also see a lot of a long term disability condition could last forever until the death of this client. The disability insurance can help the client as an income replacement to help them to pay their daily expense or mortgage or grocery. But on the other side, the critical illness usually help on a bigger cost.
When clients are applying, what is the application process on both sides?
The critical illness is different than the disability insurance because the critical illness insurance is also focused on the age, gender, and also any existing medical condition. So what the client will need to provide is those basic information. And on the other side, for the disability insurance, the most important two things is their occupation class and the income. Of course, their medical condition is also important, but it's different than the CI. We mostly will focus on some physical.
That's great. And for those that have watched the first 4 parts of this series, they're probably already contemplating life insurance. So where can the CI or DI complement the life insurance? For example, somebody suffers a disability injury outside of work. Employment insurance doesn't cover the mortgage, but it also doesn't cover the life insurance premium. So can DI have riders, for example, to cover those things?
For DI, for disability insurance, the key thing is if the client can be considered as a total disability. Of course, that is a complicated process. We need, first of all, information from the doctor, and also our claiming team will review this claim. If the client just considered as a total disability, definitely the disability insurance can cover that.
Is there riders on the life insurance for CI or DI?
For CI and DI, we do have a rider called disability premium waiver rider. For that rider, it's basically just if your client suffers some disabled condition and just be considered as a total disability during the period of being disabled, we can just waive the premium. But of course, after they back to work, finish that disabled period, the premium will be paid again.
So it is a temporary term coverage with the rider.
That's correct.
And one of the big ones on DI is return of premium rider.
That's a sweet rider. For this rider, the sweet spot is that every 7 years, we will just check the last 7 years. If the client didn't have any significant claim in the last 7 years, Canada Life will return 50% of the premium the client already paid back to the client. That will significantly lower the client's cost of insurance. So think about it. If your client is pretty healthy and for the last 7 years they didn't claim anything, you can just get a 50% of already paid premium back. So that means their cost just dropped to 50%.
I wish the Canadian government would do that with our taxes, but I don't think that's going to happen.
I will suggest all the listeners here to just really carefully check your group benefit if you have them, to see if you really have a long-term disability insurance or riders in your group benefit. Usually, more than 90% of the cases I have seen, the client who already have a group benefit, they only have a short-term disability, which is only can cover like 3 months or half a year maximum. But if something really happened to you, will last longer than half a year, you will lose your coverage for that. So please, if you don't have long-term disability insurance, it's a great time to talk to your advisor, like Robert. Just let them know you need this, and just let those professionals help you to apply for long-term disability insurance.
To book an appointment with us, those links will be in the comments below as well. So Faye, thanks so much for coming on.
Thank you again for having me here today.